was just getting started. Okay, so we're going to start with problem 30, which is in the book on page 244, 245. And so we're going to solve this as I suggested. The first thing that you do is you ask yourself two questions. The first question is, which method are they using? And the second is, how many prior years? So the method that they're using can be one of three. This one is initial value. How do I know that? Well, it tells me that on page 245, the first bullet, they bought for $657,000 in cash. And then the information that we're given is December 31st, 2015, which is a full 2 years later, and investment in Kirby is still $657,000. It has not changed. That's initial value. Because it doesn't go up for anything, it doesn't go down for anything, it just stays at what they paid. The other thing that would tell me that is, it says that they own 90%, and let's see, they've got the net income of Kirby actually is a loss of $40,000, so there would be no dividends that would have been paid. So they didn't receive any dividends. So as you can see, there's no income from, on Moore's income statement, bottom of page 244, there's no income from Kirby. Why? Because Kirby had a loss.
It says sales 600 plus 560. Wouldn't that be?
Oh, I beg your pardon. It is a net income of $40,000. You're right. I'm wrong. But it does look, when you look in the retained earnings section, dividends declared by Kirby are zero.
Yeah.
So the parent didn't get anything. They didn't get anything. Okay, so you're right. So once again, it's initial value. Why? Because the investment in Kirby has not changed. It's $657,000. If it's any other number, it's either partial equity or equity. Okay, so what would it have been if it had been partial equity? And you're right, that $40,000 is an income. So it would have been 40,000 times 90% would have been 36,000. Income from Kirby would have been on Moore's income statement. 40,000 that Kirby earned, 90% is ours, because the only thing you don't do is amortization. So if on Moore's income statement it had income from Kirby of 36,000, that's partial equity. If it's less than 36,000, it's equity.
Okay. Income from.
Okay. So this is initial value. All right. So then we've answered the one question. It's initial value. The second question is how many prior years. Well, we bought on January 1st, 14, and this is December 31st, 2015. So 2014 is our only prior year. We have one prior year. So those are our two questions. The next thing we do is we do the DDES, and this is on, in your solutions manual on the portal, page 5-32. Did you print that?
I think you gave it to us.
Okay. So 5-32 at the bottom of the page. Okay. So you have this. This is the amount that we paid for 90%. It tells you in the problem that the $73,000, which is the same rate, is the non-controlling interest. That's the 10%. So the fair value at acquisition date, $730,000. The book value, I believe, was given to you. Let's see. No, I take that back. They had to determine the book value, and so they went upside down. They said, we do know the book value a year later, which would be the common stock of Kirby, 150, and the retained earnings of 50, 590 is, retained earnings beginning of the year, 550. So you see the 550, and you see the 150 is the 700. So we know, and I would prefer to do it, I know I'm off the screen, but I'm going to try to stay here. I would say what I do know is it's 700,000 at the end, the stockholders' equity. And what do I know about the year before?
Where are you getting this one?
The 700 is the 550 retained earnings 11. Hey, come on in. 550 is Kirby's. We're on page 5-32 of the solutions manual, page 245 of the book, problem 30. So the 550 is retained earnings on January 1st, 15. We assume there's no change in common stock. The 150. So we know that this is stockholders' equity of Kirby at the end of, or at the beginning of 2015. So what I have to know is what happened in 2014 so that I can determine this. And I know that it would have gone up for net income and it would have gone down for dividends of Kirby. So let's see, net income in 2014, somewhere they tell you that, the second bullet. During 2014, Kirby earned a net income of 80. So I know this. Sorry. And then it says in the third bullet, no, where does it tell me? Declared no dividends. Declared no dividends. So this was 0. So I just kind of do simple algebra to go backwards. X plus 80 minus 0 equals 700. So I know that my book value is 620 on the date of acquisition. Okay, and so that's my book value. I plug that into my DDES. This was given and this was given, so we can compute the fair value at acquisition date, 620. And so we determined that our excess is 110, and they give you the information to tell you that these things are undervalued, and they give you the remaining life for each of them. So no goodwill, no goodwill, and then we divide each of that, and that's our annual amortization for each one is $18,000. Some of that interest, some of it depreciation. So far so good. The DDES, any questions with the DDES? Okay, so the next thing is we look down, and now we know the DDES, we know its initial value, so we're ready to begin doing our worksheet entries. But before we do, we need to decide what interest do we need. Well, they tell us in bullet 3 that there's some inter-company and intra-entity inventory. So we know, and it says there was some in 14 and 15. So that tells me I'm going to have a star G for last year, and a G for this year, and a TI for this year. All you do for this year is last year's gain undefer, this year's gain defer, and the transfers of inventory. So far so good. I also know, since I'm doing initial value, that I'm going to have to do a star C. So far so good. When I read a little further, it tells me that there is a building that was sold intracompany the day after acquisition. And so that would be last year's star, is it TA? I think they call it a TA, yes. So I've got, for last year, I've got a star TA. And then I know I've got my regular set up. But we know that because it's initial value, no D modified I. Right? We could do both, but we no D modified I. I don't know about a P. I don't see in the answers that I have a P. Nothing in the narrative. And also, because we have the transfer of assets, we will continue each year to have an ED. So these are going to be the journal entries that I'm going to need to do. So I make a list of them before I ever start. And then remember that your stars have to go first. So I'm going to do my stars first. And we'll start with the G. Now I'm going to No, I'll stay here. Okay, so the star G would be last year's inventory. So there you've got in the third bullet, they sell with a 20% gross profit rate. Remember that our formula is, now we know these, so I'm going to erase these because I only have like this much board that's in the screen.
Do you want me to turn it?
Can you see me there? Just making sure that you can see.
Mm-hmm.
Yeah, because I want both. I needed both. Okay, so then what we have then, remember, is the transfer price, transfers of inventory, times transfers of inventory minus the cost of goods sold of those divided by transfer of inventory, amount in ending inventory divided by transfers of inventory. Well, what they gave us, this middle one is actually your markup. And they gave us that in this problem. So I know that's point 2. Our transfers of inventory for the first year, for 2014, were 145. 2014, and then 2015. This is going to be our G, our star G, and our G. And these were 160, and we know it's point 2. It also tells me that on January 1st, 2015, 30% were still on hand. At the end of the year, 40%. So this is the percent in ending inventory. They were also given to you. So in this one, they've kind of done some of the math for you. So even though we learned that, we've got shortcuts. And so using the formula I gave to you, you put it in that formula, and they've done it here. 8,700 for 2014, 12,800 for 2015. So now, and also the 160, that's our TI. So we've got the numbers for our star G, our G, and our TI. Okay? Any questions? Because y'all get, this is interactive with you too. I like it so much better when somebody's here. All right, I'm going to erase this then. So then we also, let's go ahead, since it's a star TA, let's get that information in. If you use my format that I gave to you, it's the was, as if it had not happened, is, and the difference. And it was a building that in your book had a $100,000 original cost with $90,000 of accumulated depreciation for a book value of $10,000. Okay, but it was sold intra-entity. It was sold for 25. This is always a 0. It was 25. Okay, 100 minus 25 is 75. 90 minus 0 is a negative 90. Is a negative 15. So 75 plus negative 90 is a negative 15. Okay, so far so good. So we are not asked for the TA, which was 2014. But for me, it's easier to do the TA for 14 to be able to do the star TA for 15. So in 2014, my TA looked like this. I needed to increase, because this is what I have, and this is what I need to do. So I need to increase my building with the debit for 75. This is in 2014. I need to remove the gain, because there was a gain on sale of 15. And then I need to credit accumulated depreciation for the 90. So there's my 3 numbers that I used for my TA in 2014. But also, I'm going to squeeze this in right here. It said it's a 5-year remaining life. So if we had not sold it, we would have had $2,000 of depreciation. But what we've recorded is $5,000 of depreciation. We've over depreciated. 2 minus 5 is a negative 3. We need to remove. So also our ED in 2014, and it'll be the same for 2015, is let's reduce depreciation expense with a credit and reduce accumulated depreciation 3. So that would be the 2 entries I would have made in 2014. All right? Now, the star TA in 2015 will do this building of 75. This will now be retained earnings a year later. This will be retained earnings a year later. And accumulated depreciation needs to be combined. So my star TA in 2015 is building 75. Retained earnings is this 15 and this 3. 15 debit, 3 credit is 12 debit. Okay? Retained earnings 12. Accumulated depreciation is this 90 credit and this 3 debit is 97 credit. And it works. 97 equals 97. 87. 87. That's me. 90 minus 3, 87. Okay? And then we have the same ED. And we will for 5 years. So now we've got our star TA. We've got our ED. Okay? Question? Am I going too fast? Okay. So now we're ready to do all of our journal entries and our consolidation entries. So, the one more that we have is the star C. Star C. So I've done these. Let's do star C. For initial value, we need to take the number of prior years, all the prior years net income, that needs to be added because it wasn't. We know that because it's still $657,000, okay? So prior years net income is added. Prior years net income was given to us as 80. Minus the prior year's dividends, which was 0. Always subtracted. Minus the prior year's amortization, because they weren't recorded. So we would be recording the net income, removing the dividends, there were none, and recording the amortization. And 1 year's amortization was $18,000. So our star C, I'm not done yet. Also had, because the inventory, it tells you here in the 3rd bulletin, Kirby sells more inventory. So it is upstream, subsidiary to parent. And so that 8,700 that we have right here would also have to come off because that would not have been recorded. Okay, so deferred gain minus 8,700. Let's get a net there and then we'll multiply it by 90%. That gives us 53,300 times 90% ownership. Our star C is equal to 47970. And again, this deferred gain is only removed because it's upstream. If this was downstream, we would not take it off. But this is trying to adjust what the parent would have done for the subsidiary's income. They would have adjusted for the subsidiary's income. But if it was downstream, it would not be. And because Moore sold the building, that gain of, that we have, what do we have, a gain of $15,000? That was not in here. Okay? We would have adjusted for that if it had been an upstream. If Kirby had sold the building to Moore, we would have adjusted for that. So any of the adjustments to the income statement that affect the subsidiary have to be adjusted in your star C. And there's your star C. So we've got all of our numbers now.
Is that the only difference, like, when we need to know whether it's downstream or upstream?
Upstream and downstream.
Is for the star C, not any other one?
I don't think so.
Okay.
Just for the star C. The NCI income, we will adjust that as well. Upstream and downstream. So yes, we do. When we make our NCI income computation, if it's upstream, it does affect NCI. It does affect it, right? Because you would be adjusting the subsidiary's income times the 10%.
Okay.
So I stand corrected, yeah. Those are the two places that upstream and downstream matter. Okay. All right. And then, so I'm going to page down on my, go to the next page. Actually, I'm going to skip a page. And here are my stars. Here are my star entries. So we said that the star G was 8,700. It's always a debit to the retained earnings of the seller. This is an upstream. The seller is Kirby. So we're adjusting Kirby's retained earnings and crediting cost of goods sold. The only exception to that is if it's downstream and we're using the equity method. So it's not downstream and we're not using the equity method. So we don't have the exception here. So it's the normal rule, debit retained earnings of the seller, credit cost of goods sold. All right, so that one, good? Okay, and then star TA, we did that one. I had it here. So building retained earnings, accumulated depreciation, and it's the retained earnings of the seller. In this case, it was a downstream. Moore was the one that recorded the gain. We had to adjust Moore's retained earnings. Okay. The star C, we just did that, 47,970. When its initial value, almost always your net income is bigger than your dividends and amortizations. So both are increasing the asset called investment, increasing the retained earnings. The exception to that would be if it's partial equity, because it's just amortizations, they'd both be decreasing because we're just recording amortizations, which is a negative. But this is initial value, so almost always debit investment, credit retained earnings. Okay, and then we can go to our worksheet, and I'm going to go back and forward. I know I'm going on and off the screen, but at this point, I think I'm going to ask you to have out this page, which is 5-37. So, and I will start writing, I will write our setup here. But before we do, let's look at our stars. We're going to post our stars. Stars go first. And so our star G, 8,700, 8,700. It's changing retained earnings of the subsidiary. And it's important to do that because then that S is not 550,000. It's the rest of it. Okay? Again, if it had been downstream, that 87 would have been there and this S would have been 550,000. That's the star G. And then the star TA, the 12,000, 75,000, and 87,000. Put those on. And then the star C, 47,970, 47,970, which adjusts the investment to what it would have been if they'd been using equity method. It would not have been the 657 they paid. They would have added that. Now we're ready to do setup. So S, the subsidiary stock, we look for retained earnings beginning of the year on the equity statement. It is not the retained earnings down below. It's the retained earnings up here. So it's the 550 as adjusted by 8,700 is 541,300. Actually, I don't think I'm going to write them because they are on page 5-35 and 5-36. Okay, so you can follow that. Your S is here. You also, I have to scroll down. Scroll down to the common stock, 150, and there is no APIC. So 150 and 541,300 You add those two together, 90% goes here and 10% goes there to the NCI. So it must be 691,300 because I can do 10%. Okay. So 10% there, 90% there. No questions? All right. That's your S. Your A, you go back to your DDES, and the liabilities after a year. Remember that our DDES, that was back on page 5-30. 5-32, liabilities on the DDES were $40,000, but they amortize $8,000 a year. So this is 32,000 debit to liabilities is 40,000 minus one prior year of 8,000 equals 32,000. That's the second place we use prior years. The first place was in the star C. The second place is in the A. Also on here you had equipment was a 20,000, but it amortized 5,000 a year. So this is 20,000 minus 5,000 for one prior year is 15. And then brand names, 50,000 with 1 year of 5,000. This is 50,000 minus 5,000 is 45,000. Okay. You add up your debits, and 90% of the answer goes here, and 10% goes down below. Let me scroll one more line down, and I think you can see it. I'm just going to leave it there. So it must have come out to 920,000, of which 90%. Yeah, 92,000, of which 10% is 9,200, and 90% is 82,800. So it's the sum of the debits, or whatever. Sometimes you have overvaluations, but the net of those numbers, 90%, 10%. Got it? Okay. And then, so that's your A. No I. Modified D. Well, in the D, there were no dividends. So in this one, we have no D. There's no dividends of the subsidiary to get rid of.
And the modified I?
No I modified D, sorry.
Oh.
Or either way. So, but in this case, we don't have either one. We only have one, either the I or the D. And so no I modified D, or modified I guess. But there is no income on more to eliminate on more from Kirby. There's nothing there because they didn't declare any dividends. So modified I, no D. So there's no I, there's no D here. Okay. But we do have an E. Also, we have an ED, but our E is each of the individual, well, I'm going to have to scroll up and down. You have the 5,000, the 5,000, and the 8,000 from your DDES. The expenses of amortization straight from your DDES, so it's that out to the side stuff on 5-32 DDES 855, of which they consider the expense on your, well, they just put it all into operating and interest expenses. So that's your depreciation and your interest is 18,000. So there's your E. Credit 5, credit 5, credit 8. Everywhere you've got an A, you got an E on the other side. And then the sum is somewhere up in here, and they just did this one number. Your ED, reducing your depreciation expense, and then reducing accumulated depreciation. So then we've got all of our journal entries done, and I would have crossed off one at a time. That long list that I had, I would have crossed them off once I've done them all. So now financial worksheet. And we do that with, make sure that the debits equal the credits, that 1,120,770,000 for the entries columns. And then I need to work on my NCI column. So my NCI income is, separate company income is 40,000, but it needs to be adjusted for the G and the star G, because it's upstream, so NCI is affected, okay? So, let me see, I've got that on some page. NCI, oh, non-controlling interest. Should show that somewhere. There it is. It is on page 5-33. It shows what they had of 40,000, that's where they got the 40,000. Then they add in last year's deferred gain that we're undeferring, the 8,700. They subtract this year's deferred gain, the G, 12,800, to get 35,900. Then they take off the amortization, and annual amortization is 18,000, to get a total adjusted subsidiary net income on this page of 17,900. Of which NCI owns 10%. Okay? Is 1790. And we put that in as a positive number for NCI and a negative number for consolidated. So that's a credit, that's a debit. And then we finish the NCI column, scrolling down. Our NCI numbers, we would normally have some dividends, 10% of the dividends, but since there weren't any dividends, there's nothing there as a debit. But normally we would have a debit there for dividends. But this is our beginning balance. That is our net income for NCI. We would take off our dividends, and that's the ending NCI. That is a credit there and a credit there. All right. And then it's just another finishing worksheet.